Picture a market where demand collapses but prices stay high, where buyers vanish but sellers refuse to budge, where every economic textbook says costs should fall, yet somehow they never do. This is how the American housing market looks in 2026, and it reveals something profound about how markets actually work versus how we assume they should work. Housing demand has fallen to levels not seen since the early 1990s. Mortgage applications have dropped by 60% from their peak. Sales volumes have fallen to 30-year lows, yet median home prices sit just 2% below their all-time highs. The fundamental law of supply and demand suggests this outcome should be highly unlikely. When fewer people want something, the price should drop until enough buyers return to clear the market. That is how markets are supposed to function. This analysis is educational in nature and not intended as financial advice. The housing market exposes a critical gap in how we think about price discovery. We assume prices adjust smoothly and quickly to match supply with demand. We believe sellers will lower prices when buyers disappear. We trust that markets clear efficiently because that is what economic theory teaches us. But housing markets operate under different rules, governed by forces that textbooks rarely mention and financial media consistently overlooks. The disconnect matters because housing represents the largest store of wealth for most American families. It drives consumer spending, shapes monetary policy, and influences everything from labor mobility to birth rates. When housing prices become disconnected from fundamental demand, the effects ripple through the entire economy in ways that few people understand until it is too late. Most observers focus on obvious factors like mortgage rates, employment levels, or construction costs. These variables certainly influence housing markets, but they explain only the surface dynamics. The deeper structural forces that prevent prices from falling remain largely invisible to both buyers and sellers, creating a system that can persist in apparent contradiction to basic economic logic for far longer than anyone expects. The real reason this hasn't been priced yet is not what most people assume. To understand why housing prices resist falling, we must first trace how the current system developed. The story begins with the Federal Reserve's response to the 2008 financial crisis. Interest rates dropped to near zero and stayed there for nearly a decade. This created the most favorable borrowing environment in American history, allowing millions of families to purchase homes with monthly payments that seemed almost too good to be true. Between 2010 and 2020, mortgage rates fell from over 5% to below 3%. A family borrowing $300,000 saw their monthly payment drop by nearly $400 during this period. Lower rates didn't just make existing homes more affordable. They allowed the same monthly payment to support a much larger mortgage, effectively inflating what buyers could pay for any given property. The construction industry responded by building homes faster than at any point since the mid-2000s. Builders hired aggressively, expanded into new markets, and developed increasingly sophisticated methods for managing large-scale residential projects. Suppliers invested billions in expanded capacity. Local governments streamlined permitting processes to capture tax revenue from new development. An entire ecosystem emerged around the assumption that low rates would persist indefinitely. Investment capital flooded into residential real estate from sources that had never previously focused on single-family homes. Pension funds, sovereign wealth funds, and private equity firms began purchasing houses by the thousands, treating them as just another asset class. Rental companies went public and raised billions to acquire properties in growing metropolitan areas. Technology platforms emerged to help investors identify, purchase, and manage residential properties at scale. Meanwhile, existing homeowners experienced something unprecedented in modern American history. Nearly 60% of mortgage holders locked in rates below 4%. Many secured rates below 3%. These historically low borrowing costs created monthly payments so attractive that moving became financially irrational for most families, even when their housing needs changed significantly. The system appeared to be working exactly as intended. Home ownership rates stabilized after years of decline. Construction employment recovered. Property values rose steadily, but not dramatically in most markets. Credit remained widely available to qualified borrowers. Local governments collected record property tax revenues. Everyone from first-time buyers to institutional investors seemed to benefit from the arrangement. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. Banks developed increasingly sophisticated methods for managing interest rate risk across their mortgage portfolios. Government-sponsored enterprises like Fannie Mae and Freddie Mac expanded their balance sheets to support mortgage lending at unprecedented scales. Rating agencies created new frameworks for evaluating mortgage-backed securities. Regulators implemented stress tests designed to ensure the system could withstand various economic shocks. This infrastructure grew more complex and interconnected over time. Mortgage originators sold loans to aggregators who packaged them for government-sponsored enterprises, who sold them to investors who funded them through various debt instruments. Each layer added efficiency and reduced risk for individual participants, but it also created dependencies that made the entire system increasingly difficult to modify or reverse. By 2021, the mortgage market had become the most liquid and efficient in the world. Borrowers could secure financing within weeks. Lenders could originate loans and sell them almost immediately. Investors could buy and sell mortgage-backed securities with minimal transaction costs. The secondary market for residential mortgages processed trillions of dollars annually with remarkable smoothness and reliability. This is the part most people understand. The part that actually changes the outcome comes next. The first cracks appeared not in housing markets themselves, but in the broader financial system. Inflation began rising in late 2021, forcing the Federal Reserve to abandon its ultra-low interest rate policy. Mortgage rates doubled within 18 months, from 3% to over 6%. The monthly payment on a $300,000 mortgage increased by more than $600 almost overnight. Higher rates should have reduced demand and pressured prices downward. Instead, something unexpected happened. Existing homeowners simply stopped selling. The mortgage rate lock-in effect created an artificial supply constraint that few economic models had fully anticipated. Families with 3% mortgages realized that selling their current home would force them to buy their next home with a 6% mortgage, effectively doubling their borrowing costs even if prices remained constant. The mathematics were stark and inescapable. A homeowner with a $400,000 mortgage at 3.2% pays roughly $1,700 per month. To purchase a similar home with a new mortgage at 6.5% would require monthly payments of approximately $2,530. The difference amounts to nearly $10,000 per year in additional housing costs, or $300,000 over the life of the loan. For most families, moving became financially prohibitive regardless of their housing needs. This created what economists call price stickiness, but in an extreme form that few had previously observed. Price stickiness refers to the tendency of prices to resist changing, even when underlying supply and demand conditions shift significantly. In housing markets, this typically occurs because sellers experience loss aversion, the psychological bias that makes potential losses feel much more painful than equivalent potential gains. Consider a homeowner who purchased their property for $350,000 in 2019 and watched it appreciate to $525,000 by 2022. When demand falls and comparable homes begin selling for $475,000, this seller faces a potential loss of $50,000 relative to peak value. Loss aversion research suggests this potential loss feels approximately twice as painful as a $50,000 gain would feel rewarding. The seller therefore prices their home well above current market clearing levels and simply waits for conditions to improve. Austin, Texas provides a clear example of how this dynamic plays out in practice. One property purchased by an investment company for $920,000 in 2021 was listed for sale at $1,455,000 in late 2024, despite minimal improvements and a rental history suggesting the property generated insufficient cash flow to justify the purchase price. The seller maintained an asking price 60% above the original purchase price, even as similar properties sat unsold for months. The lock-in effect amplified this behavioral bias by making it financially irrational for homeowners to sell at any price. Even sellers willing to accept significant losses on their current property faced the prospect of much higher borrowing costs for their next purchase. This created a feedback loop where reduced supply kept prices elevated despite falling demand, while elevated prices kept potential buyers out of the market. Supply-side constraints reinforced these dynamics through multiple channels. Construction labor shortages, which began during the pandemic, persisted and intensified as immigration policies tightened and skilled workers aged out of the workforce. The construction industry requires approximately 454,000 additional workers beyond normal hiring to meet current demand, but wages have risen only modestly despite severe shortages in most markets. Material costs remained elevated due to trade policies, supply chain disruptions, and increased regulatory requirements for energy efficiency and safety. Land availability continued shrinking in desirable metropolitan areas as local governments restricted development through zoning changes, environmental reviews, and infrastructure requirements. The time required to obtain permits and approvals increased in most jurisdictions, adding carrying costs and uncertainty to development projects. These supply constraints made housing supply increasingly inelastic, meaning that even significant price changes produce relatively small changes in the quantity of new housing delivered to market. When supply is inelastic, rising demand translates primarily into higher prices, rather than increased construction activity. But the reverse is also true. When demand falls in markets with inelastic supply, prices tend to remain elevated because the supply response is too slow and too small to restore equilibrium. The same forces that once enabled growth now begin to work in reverse. Current market conditions reveal how these structural factors create pressure points throughout the housing ecosystem. Buyers face monthly payments that consume 40 to 50% of median household income in most metropolitan areas, well above the traditional affordability threshold of 28%. Many potential buyers have simply exited the market entirely, choosing to rent indefinitely or delay household formation rather than accept current pricing and financing terms. Sellers confront a different but equally challenging reality. Properties remain on the market for an average of 38 days, nearly double the pace observed during peak demand periods. Price reductions have become common, with approximately one-third of listings experiencing at least one price cut before selling. Yet these reductions typically amount to 5 to 10% of the original asking price, insufficient to clear the market in most areas. Builders find themselves trapped between high input costs and weakening demand. Construction loans carry interest rates of 8 to 10%, making speculative building financially dangerous. Pre-sales requirements have tightened, forcing builders to secure buyers before beginning construction. This reduces the supply response that might otherwise help moderate prices, but it also limits builders' ability to capitalize on market opportunities when they arise. Lenders face margin compression as loan volumes decline but fixed costs remain constant. Mortgage originators have reduced staff and closed branch offices, but regulatory compliance costs continue rising. Credit standards have tightened modestly, but government-sponsored enterprises still purchase most conforming mortgages, maintaining liquidity for qualified borrowers. The lending infrastructure remains intact, but utilization has fallen dramatically. Local governments experience conflicting pressures as property tax revenues remain elevated due to high assessed values, while building permit revenues decline due to reduced construction activity. Some jurisdictions have begun reassessing properties downward to reflect current market conditions, but this process typically lags actual price changes by 1 to 2 years. The fiscal impact of sustained housing market weakness has not yet fully materialized. If this kind of structural analysis is useful to you, subscribing helps you stay ahead of the signals markets usually notice last. Regional variations illustrate how these dynamics play out differently across markets, with varying supply constraints and regulatory environments. Cape Coral, Florida experienced price declines of approximately 9% from peak levels, while Austin, Texas, and Tampa, Florida saw more modest reductions. California markets show mixed results, with some areas experiencing significant price pressure while others remain relatively stable. These regional differences reflect varying degrees of supply elasticity, regulatory constraints, and demographic pressures. Markets with more elastic supply tend to see faster price adjustments when demand falls, while markets with constrained supply maintain elevated prices longer but may experience more severe corrections when they eventually occur. The system does not break here, it tightens. The weighting creates its own equilibrium, but equilibrium built on weighting is inherently unstable. Both sides of the market have become prisoners of their own expectations. Buyers delay purchases anticipating further price declines or rate reductions. Sellers maintain asking prices anticipating market recovery or rate normalization. This standoff can persist for months or years because neither side faces immediate pressure to compromise their position. The psychology operates differently than in most markets because housing transactions involve such large sums and long time horizons. A buyer who waits 6 months for a 5% price reduction saves $25,000 on a $500,000 purchase. A seller who waits the same period to avoid that reduction preserves the same amount. Both decisions appear rational from individual perspectives, even as they collectively prevent market clearing. Financial institutions enable this waiting game through various mechanisms most observers overlook. Banks carrying mortgages at below market rates have little incentive to force sales through foreclosure or aggressive collection practices. Their existing loan portfolios generate steady cash flows at rates that seemed appropriate when originated. Forcing sales at current market prices would crystallize losses that remain unrealized as long as borrowers continue making payments. Insurance companies and pension funds holding mortgage-backed securities face similar calculations. These institutions typically hold securities until maturity rather than trading them actively. As long as underlying borrowers remain current on payments, the securities continue generating expected returns. Market value fluctuations matter less than cash flow consistency for institutions with long-term liability structures. This creates what economists call forbearance without formal forbearance programs. Lenders avoid actions that might trigger price discovery, borrowers avoid actions that might reveal their property's current market values, and investors avoid actions that might force recognition of unrealized losses. The system maintains stability through collective avoidance of the mechanisms that would normally drive price adjustment. Regional banking institutions face particular challenges in this environment because their loan portfolios concentrate heavily in local real estate markets. A community bank in Austin cannot easily diversify away from Austin housing exposure. When local prices remain elevated but transactions volumes collapse, these banks experience declining loan origination revenues while carrying portfolios that may not reflect current market realities. Commercial real estate markets reveal how these dynamics eventually resolve when forbearance becomes impossible. Office buildings facing permanently reduced demand cannot maintain occupancy through waiting strategies. Landlords must either reduce rents to retain tenants or accept vacancy and potential default. The adjustment process proves painful, but ultimately clears markets toward new equilibrium levels. Residential markets differ because individual homeowners can often afford to wait longer than commercial property owners. A family living in their primary residence continues receiving utility from the property, regardless of its theoretical market value. They need not sell until life circumstances force a change, and many of those circumstances can be deferred or accommodated through alternative arrangements. The construction industry provides another lens for understanding how waiting strategies propagate throughout the system. Home builders have largely stopped speculative construction, building only homes with pre-committed buyers. This reduces their inventory risk, but also eliminates the supply buffer that might otherwise moderate prices during demand fluctuations. Subcontractors and suppliers adjust their capacity to match reduced building activity, but many fixed costs remain unchanged. Permit fees, insurance premiums, and regulatory compliance costs continue regardless of construction volumes. These fixed costs must be spread across fewer projects, raising per-unit costs and creating another source of price stickiness. Material suppliers face similar dynamics with their distribution networks and inventory systems. Lumber mills cannot easily reduce production capacity when demand falls, so they often maintain output and accept lower margins rather than shut down operations. Steel fabricators continue operating at reduced utilization rather than lay off skilled workers who might not return when demand recovers. The municipal finance dimension adds another layer of complexity because local governments depend heavily on property tax revenues that reflect assessed values rather than current market values. Assessment cycles typically lag market movements by 1 to 3 years, allowing governments to maintain revenue streams even when transaction volumes decline significantly. This lag creates fiscal illusions that can persist longer than market participants expect. A city experiencing sharp reductions in building permits and transfer tax revenues might still show healthy property tax collections due to assessment lags. Budget planning becomes increasingly difficult as different revenue streams reflect different time periods and market conditions. School districts face particularly acute challenges because education funding formulas often incorporate both property values and enrollment figures. Districts in markets experiencing demographic shifts alongside housing, market changes must navigate complex adjustments across multiple revenue sources while maintaining service levels that communities expect. The federal tax code contributes additional friction through various provisions that discourage housing market mobility. The mortgage interest deduction becomes more valuable as rates rise, creating larger tax benefits for homeowners carrying high-rate mortgages. Capital gains exclusions for primary residences create incentives to delay sales until the exclusion periods reset. State and local transfer taxes add direct costs to transactions that become more significant when property values remain elevated. A 1% transfer tax amounts to $5,000 on a $500,000 transaction, potentially tipping close decisions toward waiting rather than transacting. These tax frictions compound with transaction costs that have risen substantially over the past decade. Real estate commissions, title insurance, inspection fees, and legal costs can easily reach $20,000 to $30,000 on median price transactions. Such costs make marginal transactions uneconomical and encourage both buyers and sellers to wait for more compelling opportunities. The core mispricing lies in the assumption that housing markets operate like other asset markets, where falling demand translates quickly into lower prices. Markets have not yet recognized that mortgage rate lock-in effects, supply inelasticity, and institutional forbearance create structural barriers to price adjustment that can persist far longer than traditional models suggest. This persistence stems from the unique characteristics of housing as both shelter and store of wealth. Unlike stocks or bonds, homes cannot be easily divided, relocated, or substituted. Unlike other durable goods, housing transactions involve such large amounts and long time horizons that both buyers and sellers can afford to wait for more favorable conditions rather than accept current market prices. Financial institutions maintain confidence because their existing portfolios continue generating cash flows at rates that appeared reasonable when originated. Assessment lags allow local governments to maintain revenue streams despite reduced transaction volumes. Tax codes and transaction costs create additional friction that discourages marginal transactions. The system appears stable because all participants avoid actions that would force immediate price discovery. What would eventually force reassessment remains structural rather than cyclical. Demographic shifts that reduce household formation permanently, regulatory changes that eliminate tax advantages for home ownership, or financial stress that forces institutional portfolio liquidation could overwhelm the waiting strategies that currently support price levels. Until such forces emerge, the gap between housing demand fundamentals and housing price levels can persist far longer than most market participants expect. This is what remains unpriced for now.